Hello, and welcome to this week's edition of Tax in 10 with me, Rachel D'Souza, and Andrew Robins. After our summer break, we are back just in time to worry about the upcoming budget. In particular, there are only a few weeks left to consider if you want to take action before the budget to lock in the effect of current tax rules. So, with that in mind, let's think about the main areas you should consider.
Right. So CGT is probably the number one issue that people have been speculating about. Um, the cynic in me is very aware that in the past, whenever there's been a lot of talk about CGT rates going up, there's been a real spike in tax yield as taxpayers rush off to make disposals to capture the current rates. So if I was Rachel Reeves, I might encourage speculation about doubling CGT rates, and then stand up at the budget to announce that because I'm pro-growth and pro-business, I have no intention of publishing entrepreneurs by increasing CGT at all. And the idea being that you scare people into triggering a tax charge, and then you don't actually change the tax rate at all, so that you can raise revenue without being the horrible tax-raising politician. It's quite a neat way to raise revenue through fear without actually having to change the tax rates.
Yes, I understand where you're coming from, but the reality is it doesn't mean that there won't be an increase in CGT rates.
True.
And the problem with your cynical view of the world is that if you're wrong and rates do go up and you haven't taken any action, you will miss out on the opportunity to do so. So on CGT, my message to clients is that if you have assets that you are planning to sell anyway, it kind of makes sense to do it, do it before the budget.
Yeah.
But on the other hand, I don't think it makes sense to engineer a disposal just to capture the current CGT rates. If you're not, if you want to hold that asset for the longer term, because the reality is I would rather not pay tax, not pay any tax and hold on to that asset, rather than make that disposal now, which means I will have a tax bill, which of course I've got to fund, and then regret it in due course.
Yeah, I think there's an awful lot to that.
And also, I mean, although CGT has been getting the headlines, there are, of course, plenty of other things to think about over the next few weeks. We know that Labour is committed not to increase income tax rates, but what about employers' national insurance? Or for that matter, play around with the tax bands? I'm kind of lumping those things together because they're both areas where we could see changes, but for most people, there's nothing you can do about it. And as an employer, you might consider accelerating bonus payments to before the end of October, and I'm sure that would make the employees happy. But otherwise, changes to employers' NI or tax bandings generally, if they happen, will just have to be dealt with as and when.
Yeah, depressing but true. An area where taxpayers will have more control and where we could see big change as well is, of course, inheritance tax. So there's been lots of talk about restriction or removal of business and agricultural relief, which are those reliefs that reduce the IHT value of qualifying assets. So there is an argument for giving away that type of asset now before the budget to capture the existing reliefs as a way to escape the impact of any changes if they happen. There's a couple of things on that. Firstly, if you're thinking about doing it, you need to bear in mind the CGT consequences, because the gift of an asset is treated as if you'd sold it at market value. Now, the good news here is that in a lot of cases, CGT holdover reliefs will be available to stop an immediate tax charge. So giving away business or agricultural assets really is worth considering. But the second point is you are giving away part of your business. So you have to be comfortable with that. Also on the subject of IHT, making cash gifts generally won't have any upfront tax costs, no CGT disposal. And under current rules, there will be a potentially exempt transfer or PET for inheritance tax. Now, what that means is that if you outlive the gift by 7 years, there'll be no IHT on it at all. But even if you survive more than 3 years, the effective tax rate when you die starts to fall over time. So there is a double logic for making cash gifts now, because if the rules change in a bad way, you've already moved and locked in that 7-year period. And even if nothing happens, the rules don't change, you've still started the clock. So you maximize your chances of minimizing your IHT charge. Now, I did also, Rachel, just want to touch very briefly on the subject of non-doms, because there is still time for anyone who's not deemed domiciled yet to create an offshore trust. The problem with this is that it may prove to be expensive and totally ineffective for tax purposes. But if you are able to set up a trust now and be permanently excluded from benefit, it may turn out to be a way to exclude the whole trust value assets from your estate. It's a point to consider.
True, true. One area that we haven't touched on yet is pensions, because these are also a big issue in terms of potential tax changes. And the reality is the numbers involved with pensions are so big. So the net cost of pension income tax and NIC relief was 48.7 billion in 22-23. Yeah, should I say that again? 48.7 billion, and this is according to government statistics. So one obvious way for the Chancellor to raise revenue would be to further restrict the tax relief on pension contributions. Now, as a reminder, at the moment, the amount of pension contributions you can make is capped for very high earners, but the rate of tax relief given is equal to your marginal rate of tax. So this makes pension contributions extremely tax efficient for taxpayers, but very expensive for the government. Now, there's been talk for a long time about restricting the rate of tax relief, and there are various ideas as to how this could be done. Any changes would reduce the relief available, so anyone thinking about topping up their pension would be well advised to do that as soon as possible.
Yeah.
Staying on the subject of pension, there's also been some talk about removing the IHT benefits from pension pots. So at the moment, in most cases, the value of your pension is not taxed on your death, which means that unused pension plans can be really valuable estate planning. Unfortunately, there's nothing you can do to plan for a change in IHT rules on this particular subject, short of actually dying before the end of October. And I don't actually recommend that. But if we do see IHT changes in this area, I do expect there to be very loud protests.
I'm disappointed that you're not recommending tax planning of dying by the end of October, Rachel.
Moving swiftly on.
But the reason for mentioning this is because usually tax changes take place at the beginning of the tax year, so on 6th of April. But I think there is a real concern that this time the Chancellor will introduce changes with immediate effect from Budget Day on the 30th of October. There is precedence for this, so it's not just scaremongering, even though, for what it's worth, my guess would be that other than maybe CGT, I think most changes would be too complicated to introduce mid-year, and the benefit wouldn't be huge. So I'm not sure that a lot will change from October, but I really wouldn't be surprised to see anti-forestalling rules, though, where the idea is that if you do something after the budget, but in this tax year, and it's designed to avoid the effect of future changes, you end up being dragged into the new rules anyway. And that does mean that even if the rules don't change from 30th of October, you may need to have acted before that to get the benefit. Final comment from me on all of this. I think it's worth noting that all of the tax changes we've been talking about are definitely going to have an effect on the 40% taxpayer, and will also, some of them hit people who are paying tax at 45%. Ironically, the richest taxpayers have already been targeted by the previous Conservative government, and there's probably less room for the Chancellor to raise more revenue from that group. So in reality, this means that the group most likely to suffer the brunt of revenue-raising measures will be the reasonably well-off employed and self-employed. And that will be the case even if the Chancellor turns to alternative revenue raises that we haven't talked about here, like increasing fuel duties, for example.
Okay, yeah. On the one hand, everything we've talked about today is speculation, and it is entirely possible that none of the changes we've referenced will happen. On the other hand, the Chancellor keeps telling us time and time again that she has identified a 22 billion black hole. So if it's not these changes, it will be something else.
Yeah.
Whatever your circumstances, this means you have a few weeks to review your financial affairs and see what you can do just to take the risk out of some of these changes that are definitely going to happen.
Totally agree. And for all I've been arguing here, leaving it until after the budget in the hope that nothing bad will happen, just feels like a really risky strategy.
Yeah, agreed. Thank you for listening to us. That's me, Rachel D'Souza, and Andrew Robins. We're tax partners at RSM. Please do let us have your comments and feedback, and we can be contacted at rachel.desouza at rsmuk.com or andrew.robins at rsmuk.com.